Well, thank you for joining us for this discussion on property tax. It's the first in a three-part series that we're producing with Cornerstone Tax Advisors. The following episodes will cover finance and valuation, but today we're going to talk about different aspects of UK taxes that private client advisors should be aware of and consider. So I'm joined by four experts here today. David Hanna from Cornerstone Tax, Andrew Moir from Forbes Dawson, Pete Miller from the Miller Partnership, and also Peter Vernon Brown from the Oak Group. So coming first to David Hanna. David, welcome to the first part of this series. Stamp duty land tax is in the press a lot right now. I imagine that's keeping you busy in your work with clients and their advisors.
Well, it is indeed. But first of all, thank you very much, David. It's a pleasure to be here, and good evening or good afternoon, everybody, whenever you happen to be watching this. Yes, incredibly busy. Stamp duty. We have what I describe as the domestic turmoil at the moment, with the anticipated end of the stamp duty holiday and, we expect the return of the nil rate ban to its usual former lower level. Already we're starting to see deals being abandoned and activity in the estate agency market being, as it were, the first step in the supply pipeline of property is already starting to fall off. Mortgage applications are starting to fall off. Whether we'll actually see a cliff edge across the entire industry on the 31st of March waits to be seen. But I can predict that solicitors will be having a very quiet April, because if nobody's making offers for deals, then there's going to be no conveyancing to be done for at least 8 weeks as the market cycles up and adjusts itself to the post-holiday world.
Does the stamp duty really sort of flick the property market on and off, do you think, or do you think it's overblown, or do you think it really does have the impact to make it move?
I think massively, but it's one factor. Definitely the advertisement of holidays in the domestic, what I call the domestic market, or the retail market, if you will, has a tremendous impact, particularly at lower levels. You only had to look at the impact that first time buyers relief had when it was first introduced to understand that, yeah, people read the papers. In terms of the international clientele, the investment clientele, developers, that less so. Developers are almost exclusively unique. They tend to only pay commercial anyway, and that hasn't changed. As far as investors go, over the last few years, we've seen a number of measures. We have the flat rate of 15% for enveloping your property. We then had the 3% surcharge designed to discourage people buying second homes. Well, that worked not. Indeed, I think it's just over 50% of transactions below $250,000 are still subject to the 3% surcharge. The very market sector that this surcharge was designed to discourage investors from going into, freeing property up for first-time buyers and new entrants. And now, of course, come the 1st of April, we have the new 2% non-resident surcharge.
Is that well understood, do you think, by advisors? I mean, there's a lot of offshore trustees and international advisors on the call here. Will they have a good grasp of what that might mean for their clients?
There's been very little about it. The news cycle, including what I would describe as a professional technical news cycle, has been dominated by holiday. What is, of course, interesting is it's not just a surcharge, it's practically a standalone tax in its own right. What I mean by that is that there's a new definition of non-resident. It doesn't match the income tax definition of non-resident. So whilst our offshore trustees will be familiar with the income tax definition, they'll have to realise that this is slightly nuanced, different enough to be dangerous. A lot of offshore trustees have been making investments through UK SPVs. You'd have thought if you were buying through a UK company, you'd be okay. Well, it's not the case. If you're a closed company and a majority of your participators are not resident in the UK, and for that, there's a whole series of new look-throughs. So you can look through a partnership, a trust, and anything else that's in the way to get at where and who the ultimate beneficial owner is in order to determine whether or not you're resident. The other thing, and I've already had to correct two people on this, is that people believe that this only applies to non-British people, that it's a tax on Johnny Foreigner. It's not. It's a tax on non-residents. I've just had to advise a retired civil servant who's returning from Spain, God bless him, that he's going to have to pay it when he gets back to the UK and then reclaim it once he's been here 182 days. Chap's absolutely fuming. He's ringing the Civil Service Association to demand to know why he's not exempt.
Partnerships you mentioned is a thorny issue. I mean, you wrote an article with Andrew Marr in taxation on that topic, hugely technical area. But I mean, what are the sort of things that people need to be aware of in respect of partnerships and trusts owning property?
Well, it's become a burning theme for us now, and Andrew and I co-wrote the article for this very reason. Is that there are rules in SDLT that if there's cash consideration, you get charged to SDLT. If you assume debt, there's SDLT. If you incorporate, there's a charge on market value. What often, and all too often, gets missed is that where any of those transactions involve a partnership, either as the seller or the purchaser, and it's connected to the opposite end, the purchaser or the seller, I had to think about that one for 2 seconds, then quite often the tax charge is actually nil. And we're seeing a lot of errors in that area, and we've had to do a lot of reclaim work with HMRC over this. And one of the key areas we're seeing this is on trusts of every single stripe and colour, be it offshore trusts, onshore, pensions, international pensions. All of these are settlements for SDLT purposes, and thereby, if you were to take your property portfolio from yourself and your wife, transfer it into your QNUPs, for example, there should be no SDLT. Similarly, if you were to take your UK factory and sell it to your SAS or your SIP, and you own it jointly, there will be no SDLT. But there seems to have been a consistent, albeit thoroughly incorrect pattern of paying tax, which is, we call it, an issue of growing concern to a number of people.
And on the offshore developer investor side, I mean, when we've chatted before, you've mentioned about people giving up projects because they don't realise reliefs are available. They've not had the projects analysed correctly by professionals around them. I mean, what do you see in this space at a time when we need to channel investment, funnel investment into projects in the UK more than ever?
Well, I mean, there's two elements to that, and I'll come back to why in a minute. First of all, in what I call the retail or residential property space, so think people buying through their trusts or whatever, is quite often people will either not make an offer on a property that they want or that they feel is desirable because they haven't estimated the SDLT properly. Well, for the word estimated, read calculate. Why is that? Is because quite often they lack the specialist knowledge to understand what the correct SDLT will be. For example, people will generally look at a large country house with a lot of land and think, large country house, therefore I should be paying residential, which of course at the moment could be as high as 15% if you include the 3% surcharge, and from 1st of April could be a swinging 17%. But that large country house with all its land, that land may well make it what's called mixed use, which is only taxable at 5%, which is over 12% off your tax rate is over a 2/3 cut in the perceived rate of tax you should be paying. How many deals might go forward if the tax was correctly understood by the potential buyers? And here the online calculators are no use whatsoever. They give you no, you tell it it's either residential or not, but it doesn't say, and here's how to work it out. So and when you're investing $1 million, 2 million, 3 million in something like that, you really need to be looking at that early on. In the commercials, in the general retail space, one mortgage broker estimates that up to 40% of all offers on properties fall away because of inaccurate SDLT calculations.
Interesting.
So what will happen is that these people will go in with make an offer, then their mortgage broker will fill in their mortgage application, and he will either overestimate or underestimate the SDLT. And if he overestimates it, they fail affordability, which means they don't get the mortgage offer, which means they have to pull out. Similarly, in the commercial space, failure to evaluate the deal cost properly. We advised on a deal recently where the client thought the liability, I think, was 4.93%. They'd missed multiple dwellings. The liability should have been 1.19. Yes, it can have that effect. And that extra sort of 3%, 4% was enough to make the deal viable. So they then went ahead with a bid. They wouldn't have bid had they not come to us and asked us to calculate it in advance. Because with developers, the margins are that thin that really can make the difference.
Absolutely. Very interesting. Peter van der Brown, just to bring you in, I mean, the Isle of Man historically has had a lot of commercial property owned through Isle of Man structures with the VAT advantages and things like that. Do you still see foreign investors, developers using the Isle of Man as a jurisdiction to put structures that are developing UK commercial real estate?
We do, nowhere near in the same numbers as we were seeing beforehand, of course, because as you say, we were synonymous with property development, property investment for many, many decades. But obviously the taxes that have been introduced over the last few years, including development, etc., SDLT is a big driver to these things, is putting off a lot of people. I think what we're tending to see is if you're having overseas investors, they usually want to put through some kind of structure. And therefore, it's a case of where are they going to locate that structure and what does that structure look like? So the first port of call we always say to these guys is take the advice. Tax is moving so quickly, you've got to take the advice. Tax advice you got a year ago is just not worth it. Look at it now. Bound to be some changes because every year there are massive changes. I don't know how the tax advisors keep up with this because we certainly can't keep up with it. So the first thing we do is always get advice. And that's what you've got to do. But we are seeing structures being set up offshore, not as many as before, and that's quite clear. But there are some, we've one at the moment, which is quite a nice little development in the Midlands. I won't go any more than that. But, and as David was saying there, SDLT has been one of the biggest driving factors as to whether it's going to be profitable or not, and therefore worth proceeding with. So I know exactly what David's meaning.
I mean, David, have you seen, for the offshore investors, obviously ATEDs come in? Have you seen people like turning away from using offshore or de-enveloping, changing structures based on those tax changes?
I've seen people changing their choice.
Yeah.
I haven't seen as many people de-enveloping as I thought would do. There was when they decided that they were going to, the revenue decided they were going to allow de-enveloping and they published a protocol for it. Everybody sort of said, well, here we go, boys, doors open, let's help. And it was not even a trickle, much less a flood. I think the motivation behind people who use corporate wrappers, particularly where there's an anonymity of beneficial ownership, although that seems to be getting increasingly rare on a global basis, is actually about the anonymity. It's not about tax. It was never about tax or avoiding tax, or certainly not from the UK perspective, but more about protecting their privacy of ownership, and particularly protecting their privacy of ownership from publicity in their, what I would describe as their home state or their originating state. We had one client several years ago who rang us up and said, I'm buying a house, I want to envelope. And as it transpired, the reason he was doing so was that he did not want to have to go to the trouble of hiring security guards to prevent his children being kidnapped in his home country once his true wealth became known. And for him, it was cheaper to use an envelope and pay a TED than it was to hire half a dozen security guards, armed guards. I mean, to say he lived in not quite a failed state, but a state where kidnapping for ransom is frequent, and quite frankly often comes to a tragic end. I could understand his reasons.
Well, I imagine, Peter, in the fiduciary sector, you see that kind of motivation as well, with privacy, confidentiality being one of the major motivators, rather than it structuring being about tax today.
No, absolutely the case. I totally agree with David. He's quoted a typical example there. As I've mentioned before, tax is not the driver of why people want to invest in this property. They're either looking for these safe havens, or they could be looking for confidentiality, or it's just one more asset class that they're looking to invest in amongst the various other asset classes they've got in their offshore structure anyway. This might be for sort of Middle Eastern or Far Eastern families, for instance. So, we're talking about confidentiality. We're not talking about secrecy here. The world is very open now in relation to the regulation of information, the passing of information between tax jurisdictions. What we're trying to do is make sure that information doesn't fall into general public hands, of course. So there's a big difference between privacy and secrecy, because of course you've got the PSC register. We've got a beneficial ownership as well, register here in the Isle of Man as well, but at the moment it's not public knowledge, it's to be used by the relevant authorities. So I think those kind of structures do provide a certain amount of comfort, especially for those people with security issues.
Okay, thanks. Andrew Marr, just to bring you in, I mean, just looking at on the inheritance tax side, you often deal with trust companies, Channel Islands or Isle of Man, with foreign investors buying UK assets. Have you seen changed behaviour since these new rules have been introduced? What's the sort of typical advisory mandate you might be working on in respect of prime London real estate, for example?
Well, the big issue here is that compared to years ago, it's a lot harder to escape the inheritance tax net where UK residential property is concerned. So, in very simple terms, a few years ago, you could get out of it just by you'd have an offshore company owning the residential property, and because the company isn't a UK situs asset, it acts as a blocker for residential property. From 2017, that's no longer effective. So people non-resident people suddenly found themselves within the charge, certainly for new acquisitions. There's more complicated legislation as well, which is not so obvious. So I think everybody can understand that if they hold residential property in a company, it's going to be within inheritance tax. But what's not so clear is, for example, a case I saw was there was a guy with his offshore company. Everything was non-resident apart from the property that I'm going to talk about. But there was an offshore company. He had a few £1 million of loans to this offshore company, and he was undertaking some inheritance tax planning before he came to the UK, because he wanted to get his inheritance tax position sorted before he came to the UK. And what he was about to do was settle a load of these loans into a trust. In common sense terms, you wouldn't really think that would have an inheritance tax implication, but on closer inspection, this company to which the loans were made had a property portfolio, had a mixture of commercial and residential property portfolios, and so the way the rules work is that a portion of that loan is actually attributed to the residential property, and if he'd have put that loan into the trust, it would have triggered a significant immediate inheritance tax charge. And similarly, if he'd have just gifted it, if he died within 7 years, he would have had a potentially exempt transaction. So it's those sorts of things that you've got to look at now, which you didn't have to look at before. In that case, we managed to do a bit of restructuring to take out the issue, but because on the specifics of that fact, it actually suited us to move the residential property into a higher holding company than the company that he was lending to, and therefore taking it out, sort of untainting the loan from an IHT position. But there's lots of issues like this with all of the new rules, and property rich companies is another one which on the face of it is very is quite simple compared to the inheritance tax, and you sort of on the face of it it's quite easy. So property rich company means that now if a non-resident disposes of a company which has 75% of its value made up from property, that is a disposal within the scope of UK capital gains tax, which given that you have a base cost of April 2019, you would in many cases think that at the moment this isn't a big issue, because you'd think maybe the company hasn't gone up in value, so okay, it's a reporting issue but not a tax issue. But when you actually look into the detail of a lot of these companies, so that there's lots of offshore companies with large rental properties, and the way it works is these properties are by definition just without the property going up in value, the value of the company is going up because of the retained profits which are building up on rent. So all things being equal, I've been involved in lots of discussions where they're almost trying to push this away as a big issue, because they say, oh, the property hasn't gone up in value, so we're all right. Well, no, you've got to look at it very, very carefully, because firstly, it's not about the property, it's about the company. So if you're not careful, you end up getting a capital gains tax charge on your undistributed profits. Now, things to think about there are flushing those profits out before a sale, which can often be viable. If a purchaser was going to buy cash, usually they'll be happy to adjust the price downwards for a pre-sale dividend, but that doesn't always happen. Another big issue to look at here is where your reporting is for your April 2019 base cost, because in practice, you often have accounts which have fairly low values. They could be values that have been provided for bank borrowing, etc. And you've got to manage that position, because, and I think the best way to deal with it is head on when you're reporting. So if you've got a set of 2019 accounts which you think have an unrealistically low value, I think you've got to explain that. Often you can use the fact that only a year or so later you've sold the property for a much higher value, which is out of sync with inflation. But all of that is very important, and that sort of planning is fairly simple, but particularly the dividend stuff, but can actually save quite a lot of tax on these sorts of properties. So,
following on from what I was discussing with Andrew about on the IHT side, I mean, how are you seeing from the Isle of Man clients still owning UK property through structures? What do you observe in terms of the practicalities of administering structures that own underlying UK real estate?
Very interesting, actually, because of course the last 5 years in particular have caused a lot of upheaval for offshore structures that are administered by companies such as ourselves. We all know that ATED, of course, started back in 2013, so we've had nearly 8 years of that. Going back as far as that, we were expecting to see a fairly large downturn in business as a result of that. We were quite pessimistic, but in actual fact, we didn't see that in the end. And we found that most clients, even the top earners with the larger properties, were quite happy, in the main, that is, of course, in the main, to pay the tax. So ATED started the ball rolling back in 2013. We've had a raft of changes pretty much every year since 2015. There's been a major change to the taxation of property structures. And SDLT is still a very large, has a very large impact on this. IHT more recently, of course, is very important nowadays. You didn't even contemplate there being any IHT issues for non-domiciled individuals beforehand. So again, as each one of these nails in the coffin was driven in, we were expecting an outflow of business. In actual fact, it's been more like a steady trickle of those who might want to envelope. That is, effectively extract the property from the corporate structure surrounding it. And I think there's a number of reasons for that. First of all, I think most clients are recognizing that tax is just one of the costs they've now got to consider in relation to investing in property. So it's not the be all and end all, despite what some people think about the offshore centres. It's not totally tax driven. So I think that's important to clients. For instance, in ATED, I say, if you've got a £20 million mansion and you're still, if you just want to live in the right place in London, you're willing to pay the ATED charge. There's specific issues in relation to security as well, because the UK is seen by many overseas investors as a safe haven. They want to invest in the UK, especially in prime central London, in property, residential property, but also in the Golden Triangle in relation to commercial property. And tax, again, although it's a consideration, I think a lot of people are more concerned to invest their funds into safe and politically stable jurisdictions. A lot of the clients we have are emanating from jurisdictions which don't have that satisfaction or that advantage. And some want to do it for security reasons. It's much more serious than that. They've got to be careful about their own families' security provisions, if you like. So they're wanting to put their assets elsewhere. And so often you'll have structures which property is just one of the investments, and if they want to invest into UK, into property structures, then tax is just one of those considerations, really.
Okay, thank you. And David, Hannah, I mean, I imagine you're also involved in some of these reorganisations with a family, an owner-manager with, who's done incredibly well investing in property and then finds himself with a serious tax problem on succession or on some other event. Is that China?
Yes, I mean, we tend to have worked with UK res doms, so it's what we call a basic incorporation, usually with a family investment co, usually with growth shares. Sometimes, depending on the age profiles of the family, we had one situation where daughter and son-in-law were actually buying out mum and dad for cash on about a 6 million property portfolio, and we were like, hold on a minute. Why are we? Whenever I talk to clients and other advisors who come and say we've got an SDLT problem, my first question is, why are we doing this, and what's our end journey? What's our end point? Tell me about the destination before we discuss the details of the journey, because a couple of times we've had stuff presented to us and we've gone, look, why don't you just go route one instead of route 2, 3, through one step instead of 9 steps to get to the same result. It's a sad fact that a lot of tax guys are in love with complexity, when sometimes simplicity can be the easiest and, one would argue, the more robust route.
I mean, are you also seeing increased use of sort of cheap finance debt arrangements that can be put when people are acquiring property or insurance or things like that because of the simplicity? I mean, it can't always be arranged in every kind of example, but are you seeing increased usage of those kind of strategies?
I think what I've seen is that depending on where who the client is, I've still got clients who buy usually from Middle East area who buy multi-million-pound apartments for cash. God bless them. I'm not seeing. I think I'm seeing a lot of high net worth, ultra high net worth people are actually not leveraging to the degree they used to. They're arbitraging their debt. If you're buying London investment property, the yield per square foot is actually so small that you can't afford to leverage before you're actually underwater in cash flow terms. And it's very much about cash flow rather than tax, which it ought to be. Don't let the tax tail wag the commercial dog. it's stamp duty, significant cost. Going for tax efficiency on rents or net rents, the tax deductibility of interest. As we all know these days, a corporate wins head over heels over individual ownership and indeed non-resident individual ownership, including trusts and others. So finding that right structure and doing that. But yeah, what are we going to see going forwards? Well, I expect we'll see more non-residents buying into UK property, for two reasons. UK is still seen as a stable economy and a stable political climate in which to invest. B, I think the end of the holiday will cause a price fall. We've started to see some of that in city centres already, which actually means that the extra 2% surcharge will make no difference to the offshore investor because it's been discounted in by the seller essentially. So I think we can look forward to activity. As to the availability of mortgage finance, well, if somebody could get their crystal ball out and tell me what the liquidity of the interbank lending market on a global basis is going to be in the next 12 months, I'll buy them a beer.
And Pete Miller, just to bring you in, you're a corporate specialist, often dealing with owner-managers who have a single company owning a property portfolio underneath, or dealing with people looking to incorporate property of portfolios. Perhaps you could explain some of the issues around dealing with clients on that and the interaction of taxes.
Hi, and thank you for the introduction. Yes, I deal with mainly corporate transactions. So the area that involves me with property, well, basically there are two. One is property portfolio incorporations, and the other one is the breakup of a property holding company. Let's start off with incorporations because it tends to be an earlier part of the overall life cycle. There are two main reliefs we're generally looking for here. The first is that if the owners of a property portfolio transfer those properties into a company, even a company that they happen to own, the bottom line, of course, is that they are making a disposal. So that for capital gains tax purposes, you might assume that they're going to have to pay capital gains tax. There is a specific relief, often referred to as incorporation relief, and that depends on, in particular, the property portfolio amounting to a business. Now, there's no statutory definition of business, so we tend to have to use case law definitions, and there's some quite helpful guidance in a case called Lord Fisher, which, although it's a VAT case, was dealing with a very similar point. I think at the level where perhaps an individual or group of individuals own a couple of dozen properties, that's generally going to be a business just because of the scale, degree of organisation, profitability and so on. Conversely, someone like myself who happens to own an investment property, so just one, which is rented out, that probably doesn't amount to a business in terms of scale and so on and so forth. So there is a distinction to be made here, and it can lead to some difficult conversations around the margins. There's a case called Ramsey that looked at this quite recently and held that a single property with 10 residences within it, a house that had been converted to have 10 individual flats, did amount to a business. It's not just about the number of properties, though. It is to do with the amount of activity and organisation and so on. So if you like, scale is quite an important point, but it's not purely about the numbers in that sense. So that would give you a capital gains tax relief. That essentially rolls the capital gain into the shares that are issued so that the shares will have a lower cost for capital gains tax purposes. And if you subsequently sell the company, then the gain on the properties being transferred into the company would effectively come into charge. One benefit of incorporation in this way, of course, is that actually for tax purposes, the properties are then rebased in the company. So once the properties are in the company, for corporation tax purposes, for any gains, the properties are at market value. So if you were to sell one shortly after the incorporation, there would be very likely a very small gain or none at all. The other big issue with property incorporations is stamp duty land tax. And the issue that we need to make sure we understand here is whether there is a partnership. For some reason, an individual transferring their property portfolio into a company will not have any stamp duty land tax exemption. But if it is a partnership and the company will be owned by those partners, then there is an exemption, which can be a partial exemption if it's not quite an identical group of people. So it is important to identify whether we have a partnership in the first instance. Now, a partnership is generally governed under the 1890 Partnership Act as people in carrying on a business together with a view of profit.